Welcome to the Explainer. Last week I ran Coherent Corp through a deep, fundamental stock analysis, using 5 different valuation models, plus Warren Buffett and Peter Lynch's personal checklists, and honestly, what I found completely shocked me. Look, I get it. Most retail investors share this massive common fear right now. You're terrified you've already missed the AI boat, right? You're probably losing sleep over the very real fear of buying at the absolute top while everyone chases the exact same mega-cap tech names. But what if I told you the biggest upside isn't actually in the AI chips themselves, but in the microscopic physical bottlenecks connecting them? If a legendary investor like Peter Lynch were searching for the ultimate picks and shovels play in today's AI gold rush, this is exactly the kind of hidden in plain sight setup he'd be heavily targeting.
Seriously, stop what you're doing right now. If you own Coherent, or if you're even thinking about AI hardware, you need to see this 5-model valuation breakdown. Look at this number. A massive 429.7% one-year stock surge. In the world of physical hardware, a fast-paced number like this isn't just some random market fluctuation. It's a violent repricing of a company's entire future cash flows. And here is the craziest part. Despite this insane historical run, my analysis suggests this stock's true intrinsic value could still be significantly higher than its current price if their manufacturing scale continues. By the end of this explainer, you'll know for sure if Coherent is a sustainable juggernaut or a dangerous lynch trap waiting to catch unsuspecting buyers.
CEO Jim Anderson really hits the nail on the head here, highlighting how uniquely positioned they are to capitalize on this multi-year growth opportunity. Think of it this way. As AI data centers scale at this terrifying, unprecedented pace, the physical layer, the actual optical networking that connects every single server, has become a massive traffic jam. Coherent isn't just navigating that traffic, they're the ones literally laying down the asphalt and building the fast lane to keep the entire AI revolution from just grinding to a halt.
To figure this out, we're going to use a clear, actionable 5-step framework that you can absolutely steal for your own analysis. We're looking at 1. The AI market breakout. 2. The data center growth engine. 3. The Nvidia partnership. 4. Their strengthened balance sheet. And 5. Wall Street's verdict. Let's get right into the data. Starting off with Section 1, the AI market breakout. We really need to examine the sheer velocity of their recent top-line growth. Just look at this clear sequential momentum. They are climbing rapidly from $1.58 billion in Q1, pushing to $1.69 billion in Q2, and then boom, accelerating again to a massive $1.81 billion in Q3. That third quarter number alone, that is a 21% year-over-year increase. So we aren't just seeing growth here, we're seeing accelerating growth, quarter after quarter.
Which brings us to step 2, the data center growth engine. Let's peel back a layer and see where all this cash is actually coming from.
The crucial takeaway here is this high-contrast shift in their core business. Look at the data center and communication segment surging over 40% year-over-year. It's completely dominating their revenue mix now, making up 75% of their total Q3 revenue. Meanwhile, the industrial segment is just kind of stabilizing around $444 million. This isn't just normal business growth, it's a total metamorphosis of the company's DNA to meet this specific AI moment.
And this brilliantly illustrates the actual hardware driving the boom. You're looking at the critical optical hardware, specifically the 800G and 1.6T transceivers. You can think of these as the ultra-high-speed fiber optic cables that absolutely must be there to stop AI servers from bottlenecking. As hyperscale customers build out massive AI infrastructures, they are desperately demanding these exact components to handle insane data transfer speeds. Bottom line, without these, AI networks simply cannot scale.
Now check out how this builds. From microscopic materials innovation on the left, all the way to their high-yield 6-inch semiconductor wafers on the right. This is a massive competitive advantage. They've successfully transitioned from legacy 3-inch production lines up to this new 6-inch indium phosphide platform, and it's already producing lasers and photodiodes with higher yields. In the hardware business, higher yields literally equal vastly improved profit margins. They're actually doubling their internal capacity by year-end just to capitalize on this.
Okay, moving to Section 3, the Nvidia partnership. We have to talk about the massive corporate alliance that fundamentally alters their long-term trajectory. Guys, this isn't just a standard vendor agreement. Nvidia partnered with them specifically for advanced optical networking and co-packaged optics. But here is the real kicker. Nvidia injected a stunning $2 billion in equity into Coherent and signed a massive supply agreement extending all the way through the end of the decade.
That's not just a contract. That is a multi-billion-dollar moat providing incredible revenue visibility, firmly entrenching Coherent as a cornerstone of next-generation AI networking.
All right, Section 4, strengthening the balance sheet. With operations thriving and a multi-billion-dollar partner on board, let's see the ripple effect on their financial foundation.
Thanks to that $2 billion Nvidia cash injection, plus some aggressive debt payments, like a recent $162 million payment, Coherent's balance sheet is incredibly healthy right now. Their cash position surged to $3 billion, and they dropped their debt leverage ratio sequentially from 1.7 down to a very comfortable 0.5. Honestly, this exact type of rapid balance sheet de-risking is exactly what Warren Buffett looks for in a hyper-growth tech play. Even the major ratings agencies are noticing, with Fitch affirming their BB rating and officially revising their outlook to positive.
Furthermore, they aren't just blindly growing top-line revenue at all costs. Management is laser-focused on profitability. They're actively targeting long-term gross margins above 42%. And how are they getting there? Through manufacturing scale, like those 6-inch wafers we just talked about, a highly favorable product mix tilted toward premium AI hardware, and strict cost efficiencies across the board.
Finally, let's look at Section 5, Wall Street's verdict. Let's see how the broader market is pricing in all this momentum and capacity expansion.
Wall Street analysts are overwhelmingly bullish on this transformation. Out of 20 top analysts covering the stock, we've got 16 buy ratings, 4 holds, and absolutely 0 sell ratings. 0. The consensus median price target sits at $386, with the highest target reaching past $461. The conviction across the street is incredibly strong right now.
And the company's own Q4 guidance reflects that exact same optimism. They're projecting revenues that could break the $2 billion mark in a single quarter, specifically guiding between $1.91 and $2.05 billion. They also expect impressive adjusted earnings per share between $152 and $172. Essentially, they're telling the market that the massive acceleration we saw back in Q3, that's going to carry straight through to the end of the year. So let's put it all together. Considering their internal manufacturing capacity is doubling by year-end, their initial scale-out for co-packaged optics is just beginning to ramp, and their optical circuit switching market is now estimated to be a $4 billion opportunity, I have to ask you, is this AI infrastructure boom just in the first inning? If you want to know who is really going to profit from the AI revolution, you need to look closely at the companies building the physical internet of the future. Thank you for joining me for this explainer, and I'll see you next time.